Very good evening and welcome. You're watching the India Development Debate. I'm Tamanna Inamdar. It's a day of GDP data. U.S. GDP data has come in for the quarter and India's Q1 data is expected tomorrow for the months between April and June. Let's start with what's coming from US's GDP data. US GDP increased at a 2.1 annualized rate for the previous quarter. That was revised down from the 2.4 pace reported last month. Nevertheless, this is being seen as an improvement. US economic growth, even though a revised lower, is a still solid pace in quarter two. Momentum appears to have picked up early in the third quarter as well as a tight labor market underpins consumer spending. The economy grew at a 2% pace in the first quarter and seems to be continuing to push ahead despite 525 basis points worth of interest rate hikes from the Fed since March 2022. This is, in a sense, let's put it simply, quashing fears of a recession. So it's good news. The US GDP data is good news. It's expanding at a pace well above what the Fed officials regard as a non-inflationary growth rate of around 1.8%. So what will be the next move? Does this allow the Fed chair to slam the brakes on inflation hikes? That's part one of the whole question. But, we're talking about a dual data today. So good points coming in from US GDP. We'll see what the impact is there. That is for global recessionary fears. We're also waiting for India's quarter one numbers tomorrow. And that is expected to be above even what the RBI estimated. Let me first go across to my colleague Harsh, who's giving us a preview of what we can expect from India's GDP data for quarter one.
Well, yes, Q1 FY24 is upon us, and the GDP growth number that most economists are penciling in is an around 7.8% number on the India GDP. Now, with regard to what the RBI is expecting this number at, around 8% is the RBI projection for the India GDP Q1 FY24. Of course, unchanged with regard to the full year FY24 at 6.5%, despite those rate hikes and despite further possible hikes even in the pipeline. No real change to that GDP number for the full year FY24, so that's good. Also, with regard to where the growth is currently coming from, the RBI suggested that services is looking extremely strong as a sector. In fact, over the last 4 months, we've had 3 months where the services PMI has been more than 60. So not just expanding, but expanding fairly rapidly. That's one of the highest PMI that we've seen in almost a decade now. So clearly, services PMI is holding up very, very well, and the RBI was quick to underline that. With regard to other high frequency indicators, we are seeing GST collections also remain up in the double-digit number on a very high base. So that's heartening as well. We're seeing direct tax collections around that 13% mark as well. So that as well is quite strong. We're seeing electricity largely flat but growing nonetheless, and we're seeing credit growth also extremely robust. So overall, the high frequency indicators continue to indicate an upward trend in the economy despite the rate hikes, and of course services remain quite strong. 7.8% is where the GDP growth number is expected at year over year, 7.7% on the GVA number.
And to speak more on this, I'm joined now by Manish Singh, Chief Investment Officer at Crossbridge Capital. Madhavi Arora, Lead Economist at Emkay Global, is also with me. Welcome to both of you, and thank you so much for joining us this evening on the India Development Debate. Let me begin with the US economic data, which has come in for quarter two. Manish, fair to say that even though it's slightly below estimates, 2.1 is telling us that things are back on track. There is definitely a recovery in the US economy and recession fears are receding. Is that a fair interpretation of the numbers?
No, anything at 2% and over is something that everyone should be very pleased about, and it just keeps the recession fears at bay. It doesn't mean to say that the economic conditions are not deteriorating, but at least we are not seeing that big signs which will concern people. Because there are several things happening. And one thing we have to bear in mind that the real wage growth in the US is positive, right? The wage is growing at, let's say, 4.5 or 6%. Inflation is at 3 or sub 3. real wage growth is positive. So that is adding to the economy. I still maintain that interest rates are extremely high and this is going to hurt the economy. But the only reason it is not hurting because a lot of these loans and financing costs are slightly more longer term. So if this continues for another few quarters, then we will run into those problems of having high financing costs. But for now, we will just be, everyone is just going to enjoy this 2% growth, which is probably likely going to be bigger if you look at the Atlanta GDP estimates that is there out.
Okay. Even though the U.S. GDP growth numbers, as you say, is something that everyone should welcome, there is other signs of trouble or data points that are worrying people. For example, the job data growth that has come in, that has slowed down in August, etc. Do you see these as signs of niggling concerns that they're not quite out of the woods yet when it comes to the U.S. economy?
Well, I would think so, because as I said, that, as per what the data that I look at, I mean, these things are welcome signs, but I continue to maintain that the economic conditions in the US are tightening. And when those lag effect of high interest rates are going to hit the economy, that's when these concerns are going to become very, very real. I mean, look at the yield curve inverted, well, probably over a year ago, or at least a year ago. It doesn't mean that you have recession immediately, because historically, if you go back and look at data going back 1960s, then it takes between 14 months, sometimes even 2 years, for recession to start once the yield curve has inverted. So it's not that recession has been abated. So far, it is staying away. And one more comment I would like to make about inflation, because a lot of people are still showing those charts about how inflation can rise once again, and not least Mr. Harry Summers, Lawrence Summers, he has posted the chart. People have to bear two things in mind. In 1970s, the inflation basket was extremely or definitely very different from what it is today. And the second is that unless we really are predicting another catastrophic disruption to supply chain, I don't see how inflation is going back to those same levels. So in my opinion, rates should be cut. I don't know how long it's going to take, but that has to come to avoid a deep recession.
We're going to talk in a bit about the economy that is not put out data today, but everyone's really worried about, which is the Chinese economy, and that's a big player in this entire picture. But for now, I'm just turning my attention to the India numbers that we're expecting tomorrow. And Madhavi, let me come to you on that. 8% plus seems to be the broad consensus, beating RBI estimates. Again, is that a bit of base effect baked in?
So I think, if you look at the growth forecast, most of us are expecting, more than 7.7 to even above 8. I think it's basically, going to be a function of both fundamental and transitory factors that the economy has experienced in the last quarter. Fundamentally, you've seen very strong government capex and credit growth. In fact, central government capex, if I look at the nominal growth in the government capital spending, that has been robust, almost close to 60% in the June quarter. And even the state capex also has been almost 35% of the total capex that they do for the year, which is generally not as high in the first quarter of years historically. So this should, sharply lift the overall capex growth, which, if I look at the production side of GDP in India, should be reflected in, very high construction sector growth. Which is obviously also visible in the fact that we've seen very buoyant steel and cement consumption in the last quarter. And secondly, even on the services side, especially the financial services side, we've seen very sharp increase in the bank credit growth, almost 16-17% year-on-year basis in the June quarter, which should also feed into financial services. And more importantly, you would also see some transitory factors like very high corporate value add. Even with the falling, corporate sales in the June quarter, we actually saw the operating profits jumping significantly in the June quarter, largely led by the fact that commodity prices had actually fallen on the year-end basis. So that will significantly boost your manufacturing value add as well. And in services, for that matter, because it is deflated by WPI, which was in negative zone, that itself will boost services GDP on real basis, apart from the fact that there were certain, green shoot in services also, which were visible. But all in all, I think it will be a combination of both fundamental and, some temporary factors.
Yeah. So we might see a better than expected GDP for Q1, but let's just look at the whole year and what we're looking at in terms of headwinds. Exports still a problem because, okay, the US economy is showing some signs of improvement, but the overall picture globally in terms of demand is still a bit shaky. Pre-election year generally sees less government spends. So in second half of this financial year, you might see things slowing down. What is the broader picture emerging, Madhavi, for the full year?
I think, as you rightly said, India's recovery post-COVID has been driven disproportionately by exports. In fact, exports growth was, contribution of that was as high as 40% plus in the last 3 years or so. And it was not just goods export, but even services export, which was a big, lever for overall growth for the economy last year specifically. Also, the centre's infra push and the fact that the residential real estate has finally started seeing some steady increase over the last 1.5, 2 years, all of it had been sort of disproportionately saving the India's growth story to a large extent. But adjusted for that, the domestic private sector demand has still remained relatively tepid. Now, when you're looking into the next 1 year or so, and if the understanding is that the global growth story is going to fade, you may or may not see a recession in the West. We're still debating that, but assuming that you do see a moderate recession in the US and summer of next year, it would obviously impact your export story both on the goods and services side. Of course, you would see government spending remaining comfortable, especially in the election year, and at the same time, government infra push continuing to be pretty focused. We still would require adjustment or some kind of a green shoot on domestic demands from the private sector specifically, of which I think rural will be a big segment to watch out for, because real rural wages have been pretty much negative and have been rangy around 2% plus minus even pre-pandemic. So there hasn't been really a rural demand growth.
Are you worried about the super dry August and El Nino?
Yes, to some extent, of course, yes. But again, agriculture is, say, roughly around 20% of the value add of the rural sector. It is a non-agri, which is also a worry to the equivalent base, because, the services segment of the rural economy hasn't been really very robust, honestly. And that is why you've seen a tepid rural income in general and relatively slower rural demand versus urban demand in consumption. And I think even when you are talking to, some dealers, especially on the early signs on what the festive season is looking like, the sense is that the demand is relatively lower than what it was last year, both for rural as well as for urban sector. But of course, the divergence between urban and rural continues to stay in the discretionary spending patterns.
Manish, you want to weigh in on expectations for India GDP tomorrow?
I would like to point out one thing. One of the surest barometer of a nation's changing fortune is its evolving standard in field of sports and athletics. And I don't have to remind the viewers and everyone what is happening in India, as you have seen the performance by Neeraj Chopra and everyone else. So I feel very comfortable with the India growth story. And I have maintained this in the past as well. So I'm not going to speculate on the number, but I think that, India, for that reason, is a structural long story. And for me, nothing has changed. Now, valuation can be an issue because, if your growth is not soon enough, then the prices can go out of kilter and then readjust. But for me, India is a such a long story, and that hasn't changed for me.
Ask you, Manish, and while that put a smile on everyone's face, and everyone is very excited about what Neeraj Chopra and the relay team did. Fantastic. But is there actual study and data linking these two aspects, that nations who do well in sports do well in their economy? I'm really curious since you brought that up.
Yeah, I would say that, one has to, I haven't done any analysis on that, but if you go back and look at large economies or economies that have been powerful, they all have excellent performance in athletics and sports. And I think it's not surprising because it tells you that how physically fit a nation is. And for that to happen clearly, you can go back and look at, what is the per capita consumptions, nutrients, how healthy the nation is, what is the quality of life. I mean, there has to be a direct correlation between the two. And all that clearly can happen when the GDP is growing and the per capita consumption is increasing. You have good healthcare, good education, good living standard, and everything. So
it's an interesting thought, but I suppose it would be interesting to see there's an actual study out there? Because, you know, you have certain nations who always dominate in some fields. Race and track, for example, certain people of heritage dominate in some fields. So it'd be interesting to find out. Definitely an interesting
historically, I don't remember which nation, I think it was Netherlands or someone else. And there is a historical study on that the average height increased by so many centimeters over a period of time when the nourishment increased. So I'm sure the viewers, you know, who are more minded to do research in this can look into it. But I have absolutely no doubt that you know, there is a strong correlation, and we are seeing that happening in India.
All right.
And that is going to aggregate into growth.
All right, let me put a bit of a twist in that. One of the nations who are table leaders in medals in the last several Olympics is China.
Yes.
They're going through a very tough time right now. In terms of their economy. No, I'm not stretching the point, but I'm just sort of moving to the next bit. So I suppose taller athletes, better performing athletes is definitely not a guarantee of continuing economic performance. But let me use that segue to come on your commentary, Manish, on what's happening with the Chinese economy and what a big deal that's also going to be an impact on everyone, whether the US recovers, India grows at 8% plus in quarter one, maybe 6% plus for the full FY. The dragon's power is what we need to look at right now, isn't it?
Yes. So it's interesting you mentioned that, because my newsletter this month, which I have just finished writing, has a headline, China ailing or evolving. And my conclusion, it is evolving. And let me give you the reason. Because we have seen the Economist cover, right, which says she's failing model. Now, if you do an image search on Economist cover of China, and they have talked down India also in the past, my favorite is the great fall of China that they did in August 2015. Since then, the Chinese GDP has grown 72% from 11 trillion to 19 trillion. Let's look at the facts and numbers. IMF still expects China to grow at 5.2%. That on 19 trillion is around 1 trillion addition to GDP. So headlines can be very, very misleading. The structural problem that China has, everyone knows, and even China knows, and they're correcting it. The only reason they're not doing more rate cuts is because they don't want to hurt the profitability of the banks. And that's one reason that PBOC has given, which is justified, because unlike other parts, you know, where the banks are privately owned, they're state-owned. So anybody who's looking for Lehman moment in China will be disappointed, because first, there is no Lehman, there is no private bank. All the banks are state-owned, and they will do what they have to bail out. The second thing is that there has been history of Chinese savers and consumers using property as an asset to create wealth. That time is over. You cannot be using property as an ATM to print money. I mean, that happened for a long time. And if you look at President Xi Jinping's comment, you know, he said houses for living and not for speculation. I mean, those are something which should be followed in other countries as well. You don't just let a property bubble go out of hand. So what is happening is you are seeing an evolution. You're seeing change. They reduced the stamp tax on stock trading. Why should that be there in the first place? So when these things are going to happen, you will see reforms, you will see changes, which will accelerate growth. But for now, if anybody gave me 1 trillion extra GDP addition for a year and called it a slowdown, I'd be happy to take it, right? So I think that the headlines can be very misleading when it comes to China, when it comes to India. We have seen in the past, we have to look at the data. They have made mistakes when they went after the tech companies, but that also has been resolved. So the profit of these tech companies will be lower. But if you look at how the stocks are down 60, 70, 80%, there is big upside coming on those things as well. So I remain positive on China. I remain positive on emerging market. I think what is going to happen is the pie is going to get bigger. You're going to have big global growth as the power of the US, power of the Western world reduces. And that means cost of capital goes down in emerging market. You have more growth, and you'll really have a rapid and a bigger global growth. If we look beyond and take a 2 to 3, 5 year approach, and so on that horizon, I remain very bullish. And I think emerging market will do well, maybe more than, or certainly more than the developed market, but there's plenty going on every side for us to be positive.
So that's an interesting take, the contra view that if the economist thinks you're in trouble, you're probably going to be fine as far as China is concerned. Madhavi, your take on the fears of Chinese economy sputtering and the impact on the world?
So I agree with the co-panelists in certain points, but I think one thing that needs to be mentioned here is the fact that I think the excess savings paradox is actually eating away China's incremental gains from in the current run. Clearly, what you're seeing is the fact that the same saving investment gap, which was essentially leading the world to grow as well, because the excess savings was getting into the world dynamics and also feeding into the rest of the world's growth, is now one drying to some extent. And also, what you're seeing is that in China, at one point or in the 80s, 90s, or even early 2000s, the urbanization was still taking place. You were seeing a sustained investment boom, which was led by the fact that they needed world-class infrastructure at that point in time. Sitting today, the economic backdrop has totally changed. You still have almost 45% of national savings rate, which is the highest in the world. And that saving is no longer required as a virtue of growth funding, because the incremental investment required, especially the real estate segment, is anyway at a stagnating phase. And now you're sitting at a point where the urbanization is largely peaked. You are in the late phase of urbanization. Now merely some 10% of the working population is sitting in agriculture, which means that there's near saturation of the urban-rural labor migration / urbanization, which also means that you will see a muting demand for urban housing, and thus that would also lead to a secular fall in investment demand. There's also a diminishing marginal returns and investment growth. We are seeing the ICOR falling on a regular basis, on a consistent basis over the last 5-6 years in China, again reflecting the fact that you are sitting with high leverage over investment and obviously excess capacity. Now, all of this is happening at a time when China is also looking at a lower current account surplus. So, the difference between saving and investment tends to again fund the rest of the world's saving. But what you're seeing at this point in time is that, one, China has too much savings, and secondly, they don't want to absorb too much of it back home. And even the current account surplus is falling because obviously they are losing their edge with the West, especially on geopolitical tensions. So all of this will only lead to macro imbalance in China's economy, and the only way for them to come out of it, to probably see public sector saving, which basically means the fiscal has to expand. Last 3-4 months, the underwhelming reopening gains of China has meant that most of the push has essentially come from the monetary side. I mean, the fiscal end has been relatively conservative in terms of how they have responded to the reopening, underwhelming gains in China's economy.
Right.
I think to a large extent, what we require in China is sort of a public sector saving, which basically means higher fiscal spending, which could be debated because they obviously have a very high overall debt.
Okay.
But I think the fiscal debt is not as big a problem.
Right.
And I think the fiscal response is what will lead them to the so-called debt deflation, a vicious circle to be actually, easing over the medium term.
All right. I will have to wrap it there. But to recap very, very quickly, U.S. GDP, Q2, numbers below expectations, below estimates, I would say, but better than expected. India, estimates are that it will be pretty good, better than expectations. We'll have to wait and see what the numbers are. China in trouble. We'll have to wait and see if they can wade through. I want to thank both of you for joining us on the conversation today. I'm going to take a very short break, but stay tuned. A lot more coming up on the other side.